Investors and traders, welcome to the channel Market Chart Pattern. Today is 1st of January 2024. I hope everyone is having a fantastic day, and I wish everyone a very happy new year, a very prosperous 2024. In this video segment, we are going to take a look at the US Treasury and how the US Treasury might be telling us a possible story of what we might expect to happen in 2024 and maybe a little bit beyond. So we will also use some overlays of 10-year treasury, the unemployment data, and we'll try to make a sense of what kind of environment we could expect in 2024 for stocks and for the general economy. So this video is for educational purposes only and it is not a financial advice. At the start of 2023, in February 2023, I done a video using the 2-year Treasury constant maturity data, and we were trying to forecast that the Federal Reserve might actually be very close to a pause in their interest rate hiking cycle, which eventually did happen in the later part or the second half of 2023. However, we were anticipating for things to happen a little bit earlier on, and also the rates went a little bit higher than what we were hoping we would eventually see or achieve before the Federal Reserve starts their policy pivot. Okay, so what we are looking at is a longer term monthly data of the 2-year Treasury constant maturity, and the data goes back to 1970s, but we'll mainly focus on the data coming in from the peak, which was in 1981, and also we'll be focusing on these peaks right here. The reason is that what we begin to see is a pattern that whenever the rates went anywhere between 4 to 4.75 in that range, we have seen a change in the policy. So for example, the rates actually began to decline after that. So based on this data, we were forecasting that maybe Federal Reserve might actually be very close to their rate cycle hike for the Fed funds, as the 2-year is something which was indicating that we were approaching that range. However, in this cycle they went a little bit beyond that, and this was reflected in the 2-year treasury yields as well. So what we have, these shaded regions here, what we can see is that whenever we had a move about 4.15 or more, we were very close to getting a sort of a peak in that cycle. What we see in these gray shaded regions are the areas or the time periods when the economy went into recession for the United States economy. And what we can see quite clearly from this data is there is a trend of rates moving lower, yields moving lower, in other words. And we can see that this much, wow, 4.15 in magnitude here. This one was a little bit lower, and then we entered a recession after that. I believe it was a little bit lower for this cycle when the peak arrived because of 1987, the stock market crash of 1987, which took place in October, and maybe because of that, when things got a little bit too tight, eventually a lower interest rate environment or paradigm started. Again, we see 4.12, and then we see a rates decline, and then we see rates rise again to form a secondary peak, and then we enter a recession because the dot-com bubble bust took place around that time as well. And then what we also begin to see then is that we see a magnitude of 4.15, and then shortly after that, in 1 year's time, we do see interest rates getting lower here, but not rather aggressively. And then we entered the great financial crisis, and from there onwards the rates went really low. And then we have seen that the 2-year yields, they begin to rise. And if you remember, around 2018 time, this is the time when Federal Reserve was actually hiking rates a little bit, and of course they had to pivot again. And then a couple of years later, we went into this really short recession, which is the COVID lows. And this time what we have seen is that actually the 2-year you can see that it's risen to about 4.75, in fact a little bit higher. And this my let me actually make it to the regular, so that's a little bit easier to see now, scale wise, so I can actually make the scale go a little bit higher. So it went quite high, because this is not going to be very exact, it's a monthly chart as well. 5.1, so beyond 5. So now, how to actually make sense of what is likely to happen. What we know is that Fed has pivoted, and this is what we're looking at, because every time we have seen it rise to about 4.5 or 4.75, we have seen a pivot, and eventually it did come. Let's actually also add a 10-year yield here. So this is what we see. So what we see here in the yellow line is basically the 10-year yield here, and what we can see is that there are extended periods where the yellow line is above the blue line, which is the 2-year yield, and this is kind of expected, because 10-year has a longer duration, being 10-year, and the reinvestment risks are higher, so an investor would typically want to have a higher yield. And we have seen this for extended period after the great financial crisis till 2018 November, and then we have seen a little bit of inversion, or these moving in lockstep with each other. Then around here we have also seen 10-year yielding higher, some periods around here, and then there are also periods when we have seen an inversion taking place, where the blue line is above the yellow line, which is the case right here. And that happened somewhere around late 2022, and it has carried on for quite a while, eventually leading to a pivot. And we have seen this happen around here as well, in this region in 2006 here. And then of course we went into the recession, and rather aggressive yield falls for the 2-year. And then we have also seen this happen around here as well, and then we went into the 2000 dot-com bust, and the recession around here. This has also taken place around here as well, and then of course this moving in lockstep. So what I'm trying to say is that we need to pay attention to this kind of inversion between the 2s and the 10s. This is something which the investors also take a look at, and we have seen, based on this historical data, when this happens shortly after. Now it's not very short, immediate, but it could be in a year and a half, couple of years time, we have seen the financial conditions getting tight to quite an extent, which has led to recession essentially. Now, one of the key things is, actually, let me also superimpose the unemployment data. Now for this I will have to change the scale. I'll have to make it a index to 100. This is, we are able to see the data a little bit clearly. So here what we have to add to our analysis is that whenever there have been these really strong recessions come in, the unemployment has risen. So this cyan line is the unemployment data. What we can see is a really short-lived recession, when COVID happened, and look what happened to the unemployment rate. Just went through the roof, because the countries began to shut down. And we have of course seen a really sharp cut in interest rates, and the yields for the 2-year, 10-year falling. Here, if we just look at going back here, what we can see is that we see a period where in around June of 2006 we see a change perhaps in the paradigm for the interest rates rise, and the yields for the 2-year and 10-year, they begin to actually fall. And this is after the inversion where the blue line is above the yellow line took place, even before that. And then here it really began to take an impact because the unemployment, it stopped declining, and it actually formed a floor, and then from here onwards it just began to increase. and that's when we were right in the throes of the great financial crisis, a really deep recession. Now, I will try to find a way to have the actually rate of change of unemployment rather than just the unemployment line here, because what it would indicate is if if unfortunately people are losing jobs at a quicker rate, that's rate of change is gonna tell us that actually things are accelerating for the unemployment side of things, and that could actually lead to some sort of recessionary conditions. And here again, what we can see is that we have seen in the March of 1997 here interest rates or the yields falling. Here we go, then something happens here, and we see a rise in the yields, but the unemployment keeps on falling. And where it really gets tricky is when the unemployment is it's just no longer falling, it begins to rise. That's when we are really in the throes of a recession, and we saw a elongated recession coming here, and it actually also coincided with the dot-com bust as well. So this is why it's really important to actually also look at unemployment and put it together with the interest rates or the yields data. Another thing which I'm going to add is I'm going to actually also add the CPI. So this is the core CPI, which is in this purple line. This is the Consumer Price Index for the United States. One of the key things to look at is that, if we just go back right into the 80s, 1980, long time ago, here we see a peak in inflation. But before that, we see the interest rates. This is the 2-year yield in blue line, really massively peaking here. And that just is an inflation killer. That just killed the inflation. However, the yields actually went higher, but look at the CPI, just kept on falling and falling and falling. So whenever there has been an increase in the yields, or in other words, the rates, the inflation did come down. Here we have a one peak and a secondary peak, but the rates were still falling, and the rest of the job was just done by the recession itself. And look, the CPI kept on falling. So just trying to make sense of all of this and where we are now, we can see the purple line here, and the CPI, the inflation is really falling really quickly. Per this indicator, the Federal Reserve has indicated a pivot, and usually when the Fed pivots, it's really when the financial conditions are pretty tight, and to be able to maneuver a kind of good economic conditions, and what other people might refer to as a soft landing, perhaps, rather than going into a full-blown out recession. To ease the financial conditions, the interest rates begin to get lowered. So they haven't done that yet. They haven't lowered the interest rates, but they have put a forward guidance, and the interest rates have been on hold. And what the market is now pricing in is cuts for the Fed to come in, and we'll have to wait and see how aggressive the Federal Reserve might be, because that will tell us what sort of environment we could expect. So here we can go and have a look at two kind of data here. Here we can see, if we just go back to the June of 2006, so we have where the interest rates began to decline. So the yields for 2-year and 10-year, they are declining. The CPI is also declining, and the unemployment is kind of flat. So it's not going higher, and it's not going lower either. It's just putting a floor here. Here, the rate of change of unemployment data would really help us. And what happened is that the yields are just not moving really quickly lower. They're kind of in a range here. So there's a peak, a secondary peak, and retest of the peak, and that's when the unemployment really began to move higher, and we went into recession. So once such scenario is possible, it depends upon how aggressive the Federal Reserve might be in their rate cuts policy, if they go and initiate their rate cuts. Now, the second situation could be somewhere around here, where we are actually around here, March of 1997. We have inflation falling. We have also the unemployment falling, and at the same time we have the yields falling as well. Till a point, something happens. so maybe I don't know 9 months later on. And here there's another kind of a Fed pivot where from the rates or yields moving lower, the yields actually begin to move higher. And also the unemployment, the rate of decline begins to slow down and it begins to put a bottom in. And then what happens is that there is a rather sharp increase in unemployment. And the yields then quickly begin to move lower because the interest rates might the Fed begins to cut the rates aggressively. And here we are again in throes of the recession. So what I'm thinking is that we have two possibilities. One of this late 2000, mid of 2006 till sometime in 2007, so about a year and a half. And then we have something similar from March of 1997 to another couple of years. So it will really depend upon the interest rate cycle, how aggressive the Fed might be in their increase or decrease of interest rates, whether they will cut the rates because of the economic conditions aggressively, which the market actually might be pricing in, if they are going to do that quickly, or if they will be something like this, what happened here in the second half of 2006, where we could see some peaks because of maybe I don't know exactly what the economic conditions might have been, but maybe some surprises because of the inflation. So it will either way depend on that, on the interest rates aggressive cycle, whether Fed is going to be aggressive or not. And what it means is that what to expect, in my opinion, an imminent recession is not to be expected, which means softer lending, which in my opinion means that we could see higher stock prices for 2024. However, it could also mean that a market really trying to get clues from Federal Reserve, especially in the first quarter, where there could be an anticipation whether it's going to be an aggressive rate cut cycle. So this is something here of March of 1997, or more something like 2006 June onwards, and that could just mean that market could actually be a little bit more volatile, especially the first quarter. We could have huge ranges up and down till we begin to get a better read for the policy, perhaps coming in at the end of the first quarter. That's end of March 2024, where market really begins to understand, okay, what kind of rate cycle to be expected, aggressive rate cuts or moderate rate cuts, and perhaps even rate rises as well because of inflation or some other economic environment. And that would dictate quite a lot of the activity for 2024. I do think 2024 most likely will be an up year by the end of the year. And however, the first 3 months, the first quarter could be quite volatile in terms of price because of the market's anticipation and seeing how Federal Reserve would go along with its interest rate policy, and how aggressive they might be for the interest rate cuts if they were to happen. So thank you very much for watching the video. Apologies for the long video, but I just wanted to cover some thoughts on 2024 by looking at the interest rate data. So thank you very much for watching the video. Good luck and good trading.